If you're a lemonade investor, you probably think, at least like me, believe at some point we're going to have this rocket ship moment where lemonade really takes off. I still believe this is coming. In fact, we tweeted about it just the other day. It said, I think lemonade stock will hit an inflection point sometime in the next year or so, maybe year and a half, somewhere in that timeline where it gets a complete kind of revaluation by the market. Maybe it goes from $20 a share to $80 a share, whatever the number is. It has some kind of huge move. That's what I believe. And of course, as lemonade investors, we're wondering, is this the quarter? Is this the quarter now? Q2 2024. Are we in the quarter? Or we have to wait another 6 months or another year? When will that happen? Because I don't know. It might be this quarter, might be a year and a half from now. So when might be the timing of that? So in this video, we're going to talk a little bit about Q2 specifically. Do we think it could be this quarter? So I did a poll in the Lemonade community on X, and I said, do you think Lemonade stock will continue its run, or will it fall? Because Lemonade stock, if you've been living under a rock under the last couple weeks here, it's gone from $16, even was low as $14 a few weeks ago, back in June, mid-June, a month ago, and now we're back above $20, $21 kind of dollars a share range. So some aggressive moves over the last month for Lemonade, but we're wondering, is now they're going to continue or not? And no one really knows. 296 votes here, pretty significant for a little small company like Lemonade, people voting on this, and 52% saying yes, it's going to keep going, 48% saying no, it's going to fall. So what kind of evidence, what can we dig up? Let's dive into it in this video and see. So One thing that WK points out on Twitter, he says, good thing is that this pre-earnings rally is the entire small cap space. So rallying. So it's an increase in small cap valuations versus Lemonade earning expectations skyrocketing like we had in Q4 earnings. So that's a good point by WK. Back in Q4, we did get very excited. I think it was partly because especially Root, the other insurtech company that's focused basically entirely on auto insurance, they became profitable that quarter, and the stock went nuts. And over the weeks afterwards went nuts, and people kind of thought maybe the same thing would happen to Lemonade. Didn't quite. Of course, they're not profitable yet. It's not quite on the same timeline as Root. And then we had excitement in earnings and a bit of a collapse. So, but he's pointing out, hey, there might be a move of more funding being pushed into growth stocks. If that's a thing, then maybe it doesn't matter what Lemonade posts, but there's macro trends that are pushing it up. There's also greater macro trends in just the U.S. political scene. People believing that, hey, there's a good chance Trump's going to be the next president of the United States. A good chance he's going to win. People are seeing that as more positive for stocks. So even just forward looking into that might have, again, more reason why stocks like Lemonade just could have caught up in a bull market and could take off. I think there's some good arguments that there's some possible macro trends that are going to push that there. But looking specifically in Lemonade and where their guidance is for the quarter, so they have in-force premium of about $840 million, an adjusted EBITDA loss of about $48 million loss. So we'll remember these numbers and use these numbers, and I'm just going to show you on my Lemonade model just to sort of give a sense of, hey, how easily could they beat these numbers or be better than these numbers or outperform their own guidance, which they have a strong history of outperforming their guidance. Henry on Twitter, Henry Invest, did a really great analysis of a summary table of how often and how much they've beat Lemonade's guidance, and they have a strong history of beating their guidance. You can see IFP guide versus actual. There's times they're beating it by 17 million, 20, 21 million. They're beating it. Other times it's been tighter. Like here, it's only a $4 million beat last quarter. So, but they have a history of basically significantly beating it. Same thing with adjusted EBITDA. So you should expect they will beat it once again. But how easily is that sort of possible? I'll give you a quick analysis of that in my own model. And this model is available to my Patreon members. If you want to join my Patreon, you can get full access. Do appreciate everyone there who's supported me there in the channel there. It's really, really encouraging and awesome. But then this model here, just to give you a bit of a sense, and I'll be doing a little bit more detailed Q2 preview video in the next couple weeks before earnings come out. But if you get to $850 million IFP, which is 25% year-over-year growth, and if we have 80% gross loss ratio, and we're spending, in this example, $120 of customer acquisition cost per customer that we're getting, and your total expenses as a percent of GEP, gross earned premium, goes down to 52% from 53% last quarter. You punch all that in, you can get to adjusted EBITDA of -43, -44. So a small beat on, a bit of a beat on the numbers they're showing here for adjusted EBITDA, as well as a bit of a beat. I think it was 859 is what I had for IFP. That's adding, that's 6.5% customer growth quarter over quarter and 1.6% premium per customer growth. So that's bumping up as well as your customers. And so, but you get to that, that number pretty easily, and you're in that adjusted EBITDA range. You're at, -44, and they're at -49 to 47 kind of range what they give. So it's very I think, is Lemonade going to beat their guidance once again? Probably, very likely. I think probably will beat their guidance unless maybe the loss ratio is really, really bad, which we'll get to in a minute. But one concern I do have, though, is the guidance of Q2 into Q3 is, and I have a couple tweets here that relate to it, is I point out here, hey, in last year they spent $55 million on customer acquisition growth. This year, they plan to spend about $110 million. This was from their Q4 letter. And they spent, in Q1, they spent $19.8 million, which leaves still about $90 million of budget to spend over the rest of the year, or, on average $30 million a quarter. But typically, if you look at this chart, Q3s are their highest quarter for growth. Q4s are their lowest. Q1s and 2s are kind of somewhere in between, equal. So I'm thinking, maybe if they spent $20 million last quarter, maybe they're still going to spend $30 million this quarter, $40 million maybe in Q3, and maybe $20 million in Q4, something like that kind of breakdown. And if they have a huge amount of spend on customer acquisition in Q3, that's going to hurt their adjusted EBITDA for that quarter. It could make their adjusted EBITDA look worse for Q3 specifically. And it could even, and of course, then their guidance is going to look worse from Q2 into Q3. And you wonder then just how is the market going to react to that? I tweeted more specifically about that. Like if they're ramping up that growth in Q2, like we're going to see now, it could water down those results a bit. Their own adjusted EBITDA gets hurt by increasing your marketing spend. And then Q3, it's going to hurt it again. So just not sure on an adjusted EBITDA basis how the market's going to react to that, or really see or understand that, hey, Q3 might just be going nuts on their spending for growth, which is great. As a long-term investor, that's great. We want to see that, but I don't know. That makes me more pessimistic on the results of the poll that, hey, the stock's going to take off and fly like the rocket ship moments right here. We're right at the doorstep. Don't know. Again, don't have the answer in this video. I'm telling you, I don't know the answer. Nobody clearly knows the answer 100%, but see if we can think probabilistically and get a little closer. That makes me, that adjusted EBITDA thing that they're going to probably spend a lot more on growth, especially in Q3, makes me a little bit nervous about expecting it to skyrocket take off this quarter. Okay, so adjusted EBITDA is the one concern I have. But the second concern I have is the loss ratio. The loss ratio is I'd say it's quite challenging to predict, and it can be pretty bumpy ride, and the market in the past has not responded well to the loss ratio. And let me remind you, so here we are looking at a nice big graph of Lemonade here over the last few years. You can see we had that very pessimistic down to $14 a share. Loved that. Was able to buy shares again at $14, and then we come back up to all the way above 20, right? And If you think back, though, a year prior, let's go back 1 year to 2023 in the July months there, something similar happened. We were down at, in this range, $17 a share for a long time. It traded around there. It traded up all the way at 24.34 was at, and then right here is earnings. That big red candle right there. There's earnings. What happened? It went from $20, boom, all the way down to, shot down to like 17, 16, and then basically slid all the way down. That's where we had that massive slide all the way down to October of 2023. It's down to like $10 a share, right? So what happened right there? Let me tell you what happened, or remind you. The loss ratio for Q2, we're talking about Q2 of last year was 94%. So the previous 2 quarters hadn't been great either. Gross loss ratio was 94, 89, 87. It was continuing this kind of slow trend downwards, and I think we were expecting, hey, it's going to be 83% or 85 or whatever it is, somewhere between 80, 85%. And then it was 94%. And they had worse windstorms. And if you go back to that letter, they talk about different details like that, kind of explaining how it was these different anomalies that made the loss ratio worse. And the market did not react well to that. As you can see in the chart, just plummeted down. But even back then, a year ago, we were kind of thinking, hey, maybe this is the quarter things break out. Guidance is really aggressive, and all these things check the boxes, and the market says, yes, we love Lemonade. I mean, even adjusted EBITDA probably wasn't even that bad. Here, if we go back to Q2, they beat on their guidance. They had 56 million loss, and they did 52. So beat on their guidance there, but it didn't matter. Loss ratio was at 94%, and the market freaked out entirely. So, and that, to me, that is a huge question before people are like freaking out to FOMO, buy Lemonade, go crazy, because this is a quarter where things take off. Again, nothing on this channel is personal financial advice. This might be the quarter. We don't know for sure, but we need to find out more about what the loss ratio for Q2 might be. My own side math here, if you look at a few possible scenarios. One, I have a bit of numbers here. You can even just pause and look at this. But if you look at a few different inputs for Q2, at a gross loss ratio that's 100%, so really bad, all the way down to 72%. And depending on how much you're spending on marketing, this one shows if they buy each customer at $140 a customer on average. And you have, a spread of adjusted outcome, EBITDA outcomes of minus 60 something to minus 40. Now they've guided in the 40s. I think they'll probably be in the 40s or, high 40s at the worst you would expect. So might be, which would show that the loss ratio maybe is more close to the 80s, but again, it's probably hard for them to really predict the loss ratio as well. And then if at a customer acquisition of $120 a customer, so they're spending a little bit less to get the same amount of customers, and you have a little bit less spend in the quarter of sales and marketing spend, then you can still have a higher loss ratio and still be close to that range. Maybe it's 88%, and maybe it's not 94%, but maybe it's 88%, and you're somewhere in there around like minus 50 adjusted EBITDA. And it's sort of interesting to think, how would the market react to that? That's not really terrible, but if it's really, really bad, like 100%, and adjusted EBITDA is much worse than we expected, it could be a very bad quarter very quickly. And how I'm thinking about the loss ratio for the quarter, here's a bit of, again, sort of quick math on the side. Again, I'll go into more detail, might change some of this, but more detail in another video. But I'm saying gross loss ratio last quarter, Q1, was 79%, and ex-cat was 63%. And I'm saying, I did some of this calculations in previous quarter where I said if they're adding their rate, they're increasing the prices of their products, it naturally just lowers your loss ratio. So I'm saying there's about a 3% effect on that, just from you're increasing the prices of your products. So then your loss ratio has to come down as a part of that. And then I'm also saying, hey, there's an inflation effect, that prices of things continue to rise. There's still inflation. Again, these are pretty rough numbers, but giving a 1% raise for that, and they overall then nets you out to gross loss ratio ex cat. Maybe we're at 62%, right? But then you got to think, well, what's the catastrophic effect? And that's really the unknown. I'm putting in 15% right now, and that gets 15 plus your 62% gets you to 77%, right? Last year's, for reference, we were at 21%. So, if this was 21, they're more at 83. So really not that bad. Like, pretty solid. If we scroll back down to kind of these results here, even at $140 a customer, which is not as great, but 83% gross loss ratio, well, then you're at you're right in that range of maybe where we roughly expect the quarter to come out at. If we're a little bit better and they spend a little less on marketing on the quarter, then, hey, you're even maybe beating guidance a little bit. You're in that sort of range. So all that sort of numbers are checking out, making sense. But maybe the catastrophic event's much higher, and we don't even realize that. If it's 30%, only a 92% loss ratio, things could get really ugly really quick. Prin on Twitter, on X here, has done some great posts where he's been looking at Progressive's catastrophic numbers, other insurers' catastrophic numbers. So Progressive actually releases numbers on a monthly basis. So back in June, when they were looking at the May numbers, he said, I did some crude Q2 loss ratio predictions on the terrible Progressive report from Friday. It doesn't look good. Based on their cats, my model's giving me Lemonade Q2 gross loss ratio between 90 and 105, quite likely above 100. The cat portion of the loss ratio between 25 and 40. So yeah, not great if he thinks that's true. Riley also chimed in and said, I've done some work on this too, because it's not really apples to apples comparison, right? They're two different businesses with two different, totally different mix of products, and sell their products to different customers in different places. So it's very, very difficult to sort of compare these apples to apples, but at least it's something. And Riley said, I've done some work on this too. Not sure how closely it ties with you, Prin. Comparing Progressive home loss ratio to Lemonade, I have a 94% correlation since 2023 Q1. Overly simplistic analysis. So he basically had their home loss ratios versus Lemonade's overall loss ratios, and then found how much they correlated at 94%. And Sean also got it at 91%. As per their catastrophic is quite volatile. The effect size on Lemonade not be as bad as some would expect. Would expect to be quite bad though. So, of course, nobody really knows. If you want the Progressive numbers, I'll just pull those up for you too. This is for their May release here. And scroll down and you look at their property business. For the month of May specifically, you can see they had a net catastrophe loss ratio of 173 and a LAE ratio of 255. So really, really, really bad May, and it says represents catastrophe losses incurred during the period, including the impact of reinsurance as percent of net premiums earned. During the month, we incurred catastrophe losses related to severe weather throughout the United States. 3 events, which primarily impacted Texas and the Midwest, accounted for nearly 60% of the catastrophe losses during the month. So in summary, though, the 2 main concerns I have are the adjusted EBITDA. Where's that really going to come in Q2? And then guide for Q3 could look not so great, and the market might be kind of spooked by that, or not like that, or not maybe necessarily fully understand that. And then the loss ratio. What's the loss ratio going to be? And we don't know that exactly. We'll find out more with Progressive releases their earnings tomorrow. So that will be really key. And I have to look. I think there might be a few other insurers that will be releasing their earnings before Lemonade does. So back to this poll. Do you think this is And if you have some data or information to back it, even better. But you think we're going to continue to run, or we're going to fall back down, somewhere into the teens? We'd love to hear what your thoughts are. So let me know in the comments down below. Thank you so much for watching. Remember, it's in the bag.